Hey guys, my name is Max. I got a good video planned out for you today. I was reading the internet this weekend, dangerous, right? And I found an article that slammed YieldMax. Well, anyway, tonight I'm going to evaluate the article and tell you my opinion. All right, guys, stick around and we'll get right in the middle of it. The investment world is buzzing with controversy as Ben Eifert warns against crowded option strategies, a category that includes blockbuster funds like JEPI, Misty, and even ULTY and YieldMax and lots of other ones. This critique from a prominent hedge fund manager like Ben has reignited the debate around one of the hottest investment trends of recent years, covered call ETFs. Now, I've included a link to the original article, and I would advise you to go read it yourself and draw your own conclusions. I'm just going to tell you what I got out of this. Okay, first of all, I did a little research. Who is Ben Eifert? Ben is the managing member and CIO of QVR Advisors, previously co-founder and co-portfolio manager of Mariner Korea in New York and the Wells Fargo prop trading desk. He holds a PhD in economics from Berkeley, and he's the co-chief investment officer of QVR Advisors. QVR stands for Quantitative Volatility Research. They are a San Francisco-based firm that manages volatility and derivative strategies. QVR operates as a data-driven quant hedge fund, trading options and volatility strategies for institutional investors. The firm offers multiple strategies, including absolute return, hedged equity, and volatility convexity approaches. They don't give you specific fee information, but they don't disclose it. But typically, these types of firms charge management fees around 1% to 2% per year, but plus a performance fee of 15 to 20%, meaning they get a cut of the profits. Full disclosure, I follow Mr. Eifert on social media, and I've always enjoyed his content. He's one of my favorite option bros. Eifert's criticism centers around the notion that these strategies have become overcrowded, and I believe he's right about that. As someone who specializes in volatility trading, his concerns do carry weight. But it's worth noting he might be talking his own book. QVR competes in the same options and volatility space as these ETFs, potentially benefiting if institutional investors shift capital out of these retail accessible covered calls and back into more sophisticated hedge fund strategies like he happens to run. Ben's warning comes at a time when funds like JP Morgan's JEPI have seen explosive growth. JEPI gathered $13 billion in AUM in 2023 alone. This massive inflow could indeed create the kind of crowding that makes certain option strategies less effective. However, there's another side to this story. The recent success of covered call ETFs isn't just hype. It's been driven by a unique convergence of market conditions that have created an almost perfect environment for these strategies. The Federal Reserve's aggressive rate hiking cycle from 2022 to 2024 has fundamentally changed the option landscape. Higher interest rates translate directly into higher option premiums through several mechanisms. Time value. Options derive much of their value from the risk-free rate, from interest rates, which serve as a baseline return. So as interest rates go up, it makes the time value of options go up. Volatility premium. Rising rates often coincide with increased market uncertainty, boosting implied volatility. The rate environment has allowed covered call strategies to generate yields that would have been unheard of during the ultra-low rate period of 2015, 2016, and even 2017, when volatility was super compressed and option premiums were historically thin. The counter-argument to Eifert's warning is rooted in market cycles. Investment strategies that work brilliant in one environment often struggle in another environment. The 2015-2016 period serves as a perfect example when covered call strategies would have been far less attractive. VIX, which is the volatility index, traded below 15. Option premiums were compressed. The market exhibited persistent low volatility uptrends that would have seen lots of covered calls get exercised away. Interest rates hovering near zero provided little time value to boost options. If we return to such an environment, characterized by low volatility, compressed premiums, and near zero rates, covered call ETFs would likely see their yields diminish significantly. The distributions would go way down. In such conditions, investors might find themselves giving up upside participation for a relatively meager income. If you look at XYLD's dividend from mid-2015 to mid-2016, they paid about half of what they currently pay due to this volatility compression. QYLD, which is a covered call fund, as XYLD is from Global X, paid 7.9%, and XYLD paid 5.9%. Lately, they've been paying about twice that. So just think what this would do to an ETF like ULTY. Using the Global X ETFs as a proxy for market volatility and how much you can make off covered call strategies, we might likely see ULTY's yields in the 30 to 40% range. They would likely get cut in half. MSTY fans have experienced a similar volatility crash in MSTR lately that has cut Misty dividends in half. It can happen to ULTY also. Just FYI, I'm not predicting it, but it is possible. If you look here at this chart, this is mid-2015 through 2016. You could see right here, this is just not a good year for option strategies. QYLD, which is sells covered calls on the NASDAQ, had a 0% total return for the year, and they only made $1.89 in dividends on something that cost $23. Like I said, it was 7 point something percent. XYLD did even worse. Well, they did a little bit better in total return, but not just a whole lot better. But their dividends were only $2.28 on something that cost $45. That was like 5%. I also wanted to show 2017. Now, 2017, the dividends were still low. However, the total returns were improved, but the dividends were still about in the same spot. I didn't want to look like I was cherry picking, but 2017 has the lowest volatility in my lifetime that I can remember. At least that volatility index I was talking about. I've never seen it lower consistently than it was in 2017. Now, QYLD and XYLD did have great return, like I mentioned, but it surely didn't come from the dividend, as they only earned 7 and 5%, respectively. And really, I mean, 7 or 5 isn't terrible when you consider how low interest rates were. You surely couldn't get anything from a T-bill. So, I mean, 7 and 5 were still good, but it's not the yield we've become accustomed to. These popular vehicles produce high income at a cost. As Morningstar notes, the trade-off has always been clear. Covered call strategies exchange the unlimited upside potential you have in a stock for current income. So in a bull market with a persistent trend where the market's trending up, this can be a costly exchange because you're cutting off your upside, right? Yet, for income-focused investors, particularly in retirement, this trade-off has often proved attractive, especially lately in the current environment. The key question is whether investors understand they're making a bet on continued volatility and continue elevated option premiums. Both sides of this debate have merit. Ben Eifert's concern about the crowding are legitimate. When too much capital chases the same strategy, returns often deteriorate. His expertise in volatility trading gives him a unique insight into how these markets function. But dismissing covered calls entirely ignores the fundamental shift in market conditions that has made them viable. The strategy's recent success isn't purely a function of marketing or investor naivety. It reflects real changes in interest rates and volatility that have created genuine opportunities. I have here a chart of the interest rates for the past 15 years, and you can see from 2011 to 2016, they were hovering right around zero. Even in 2017, they went up, but even by the end of 2017, they were around 1%. And then from 2020 to 2021, they went back to right around zero, less than 1. The first high yield ETFs introduced by YieldMax came out, and I marked it on the chart at the end of 2022, when interest rates were above 4% and rising. I believe that was OARC and Tesla, and they came out in around Thanksgiving of 2022. Then the rest of the YieldMax line came out in 2023 and 2024. Nevertheless, the entire time that YieldMax has been in existence, rates have been above 4%. Remember, this coincides with higher option volatility. Recently, QYLD and XYLD have been paying 12% because they can earn more option premium and higher volatility in a higher interest rate environment, which was, more than twice what they were paying in the compressed time. For investors considering covered call ETFs, the key is to understanding what you're buying. These aren't magic yield generators. They're sophisticated strategies that work well in some environments, poorly in others. The current environment has been favorable, but that could certainly change. Ben Eifert's warning serves as a valuable reminder that no strategy works forever, and crowding can indeed reduce effectiveness. Like I always say, nothing lasts forever. But writing off an entire category because of one manager's critique, especially one who competes in the same space, would be equally short-sighted. The truth likely lies somewhere in the middle. Covered call ETFs can be useful tools in the right circumstances, but they're not panaceas. As with any investment, understanding the underlying mechanics, the current market conditions, and potential risk is essential before committing your capital. As we move forward, watching interest rate trends and volatility patterns will be crucial for assessing whether the strategy's favorable environment persists going forwards, or whether we're headed back to to a compressed, low volatility world, and that might make Ben Eifert's warning look prophetic. From Hill Country with Love, Max out.